What Your Bank Doesn't Tell You, a podcast by You Mushroom.
Hello everybody and welcome back to our podcast, What Your Bank Doesn't Tell You. Today we have another special edition in connection to our Investment Challenge 2025. I'm very glad to have a guest with me today. Hello Nima, welcome.
Hello Tonya, thanks for having me here.
Nima, you are responsible for the ETF distribution at Invesco. And for those who don't know, Invesco is one of our partners for this investment challenge. And of course, Invesco is one of the biggest asset management companies. Maybe you can give us some background about your company.
Yeah, about Invesco, sure. We have active strategies and passive strategies, ETFs. We are known for being the fourth largest ETF provider globally. At the moment, it's standing at 850 billion ETF assets, which is quite a lot. And if you combine active and passive, it's around 1,800 billion. So one of the largest asset managers, as you said, on active, but as well on the passive side.
And I also read that you're active in 25 countries with, I think, roughly 8,000 employees, which is
true.
a big company,
correct.
right?
Yeah, that's correct. 8,000 employees based in Atlanta. It's a US company, but very big hub in Europe as well. In the UK, in Switzerland, we are 20 people. In Zurich and in Geneva, so strong foothold here as well. And yeah, so that's Invesco.
And in respect to you, I mean, you are in this asset management industry for almost around 20 years.
Yes.
So I'm very honored to have you here with me in this podcast today. And I'm very curious to get your insights about the mutual fund and ETF business. And given you have experienced the past 20 years in this industry, you have also experienced the developments. And maybe, we will get to that. I don't want to jump. So, Nima, when you did the introduction of Invesco, you also started with ETFs. So maybe you can also explain why ETF is in the focus, maybe for you and for maybe Invesco, to a certain extent for Invesco as well.
No, I mean, clearly, if you look at the trends in the asset management industry over the last decade, that's exactly the area which is growing, which is the ETF and passive industry. Looking at the US, it's since 25, 30 years, there are index products. It started with index funds, then it was the ETFs. So the European industry is approximately 10 years behind the US market. And as you correctly say, when I joined the ETF industry, it was around 2008, 2009. We had like around 50 billion European ETF assets totally. So that was the entire amount. Nowadays, that's sometimes a monthly flow for the European providers. So that's showcasing how much ETFs are important for asset managers, and maybe a few aspects why. Why we see maybe this growth, or
Nima, for those listeners who are not so familiar with financial instruments, maybe you can also briefly explain before
what
you go
ETFs
into
the
details exactly what ETFs are, and maybe also the difference between traditional funds and the ETFs.
Happy to do that. I mean, an ETF is not so much different than a traditional fund. So a traditional fund is managed actively by a portfolio manager who's taking active decisions on the US market, for instance. So they over and under weight certain stocks. They select certain stocks where they have high conviction in those areas and sectors. So that's how an active fund is working. So you try to outperform the benchmark.
So they do research in respect to outperforming.
So it's fundamentally based. They look at fundamentals, at the balance sheets. So that's one area you can manage actively. The other one is quantitative. So quant managers are getting more and more. They work. It's more automated, the way they invest. So that's really on one camp. So that's active management. An ETF is also a fund wrapper. So very similar than active mutual funds, but with a big difference. There is no active element of a portfolio manager who takes bets on certain areas of the market, which means you replicate one-to-one an index like be it SMI, be it S&P 500, and you get the performance of this index. It's a diversified basket, which means the risks tend to be lower if you compare it to an active high conviction manager because you buy the market. Yeah, so that's one differentiator to active funds. And the other thing is really it's listed on an exchange. That's why they're called exchange-traded funds.
Clear.
By the listing, you can trade them like a stock intraday from 9 to 5 p.m. So the trading times of the exchange. So that's really how an ETF works and functions. You have them on equities, on fixed income. And then the other parameter is really around the fee level compared to active funds. Because of course you have a lot less human or portfolio managers and analysts involved, so the costs are lower, and that's exactly what then the product costs is embedded in the product cost, which is lower compared to an active fund. If you compare that, S&P 500 costs around 5 basis points,
that's amazing.
0.05%. If you look at an active manager, it's sometimes around 1%. So,
if you're lucky.
So you have three points. One is the listing. You can trade it immediately, the ETF. Second is you get the market. So US equities, for instance, S&P 500, for instance. No active bets. And the third one is the price. So it's tends to be cheaper. Having said that, maybe one word before... There is a new trend now in the market, which is called active ETFs, but maybe we can speak about that later.
Of course, we will come to that.
Yeah.
But in other words, or just to summarize very quickly, so an ETF is legally a fund, but more efficient because it's just investing passive, replicating an index.
Correct, yeah.
Perfect.
Yeah.
So maybe we can go a bit more into the development of the market and the entire fund or ETF business, and you mentioned the volume, which was very tiny at the beginning, and then it increased over the past years.
Yeah. I mean, that's what we see not only in Europe. We see this similar trend also in Asia. So more and more investors are going passive. Because if you look at Morningstar data, that's a database where you can compare fund performances over years and decades, for instance. There are not many active managers for US markets, for instance, that outperform the market. Yeah,
you can compare as well on your mushroom the ETFs with various funds, and we do that a lot.
Yes, that's correct. So exactly. So that's where you can exactly then compare and see, okay, what is the alpha, which is called in our nerdy terms. Alpha means outperformance versus the benchmark of an active manager. And there are not many in certain areas. And those areas are markets which are very efficient. The more efficient the market is, the less alpha potential you have. And that's exactly the reason why ETFs are dominating nowadays the asset management industry, because markets are getting more and more efficient, which means at the same time it's harder and harder for active managers to outperform. Having said that, yes, in illiquid spaces, active managers have their space because it's difficult in illiquid areas to have an ETF. And in small cap, there you can add value with an active approach. But like having said that, in the US market, for instance, that's better to go passive. And that's also the reason why we see this big trend. And then there is a second trend, which is self-directed investments via digital platforms where you can set up an ETF saving plan. So people educate themselves more and more. And that's where your mushroom comes into place. Using these platforms, using podcasts, using the research of your mushroom helps to educate yourself, and at the same time then to select an ETF, for instance, or 2 or 3, depends on your strategy. And then investing on a monthly basis, recurring, and that's a big driver of growth for the ETF business as well. And we see that in Germany, there are around 7 million saving plans at the moment. It's a lot. And there are many studies that see that the growth rates will increase in the entire European space. In Switzerland as well. So we went live with saving plans with the various platforms, be it Neon, be it You, be it PostFinance, Swissquote. All of these platforms offer saving plans.
Yeah, we are catching up in Switzerland.
Yes, correct. So that's also a growth driver.
But Nima, when I listen to you, it sounds like it was very easy just to select some ETFs, do a saving plan, etc. But then again, when I look at the universe of ETFs, and we don't speak about funds, the universe is huge.
Yes.
How do I select?
Yeah.
What do you suggest?
Well, use first of all you mushroom to
Of course, it makes it easier.
Look at a database, I would say. No, I mean the most important thing is there are a couple of factors. First of all, me personally, I would look at the big providers out there. So it doesn't need to be Invesco. It could be iShares, Amundi, all of these ones who are big providers in that space. Okay, so that's the first thing.
And why would you go for size? Or why is it so important to choose a big provider?
Because they're dedicated to the ETF business, which is a scale business. The bigger you are, the better it is in the ETF space because the costs can get lower. So that's a very important factor for selecting larger providers. But then within the large providers, don't always go to the market leader. Why? And then that's one aspect I can speak about because if you look, for instance, at there are two replication methods. One is physical, one is synthetic. You have very big tax advantages if you go synthetic for US equities, which will be S&P 500, MSCI USA, Nasdaq 100, Russell 2000, S&P 600 small cap. All of these ones, if you invest into those ones synthetically, they're tax exempt for the US withholding tax. What does it mean? Sorry, it's a bit technical maybe, but in the US on the dividends, you have to pay 30% US withholding taxes. Yeah, so let's say a dividend yield of 2% means you pay 60 basis points of US taxes on your ETF. There was a legislation change in 2017 in the US. Since then, the synthetic ETFs, which replicate those indices that I referred to, they're tax exempt. Yeah. So, for instance, we at Invesco, we replicate all these synthetically to have this tax benefit for investors. They don't need to do anything. They just get 100% of the dividends without any tax deduction.
I'm very glad that you're mentioning this replication method because when I talk to so many people in the market, the perception is always that the physical replication is kind of more intuitive, more solid, etc. And people are watching out for the physical replication because they see the stocks and it's kind of more tangible. Yeah. So I think this is a very important point that you get these tax benefits if you have a synthetic replication.
Yes, physical sounds more easy, more intuitive. But if you look into the details with the physical ones, you can do securities lending, and all of these aspects. And at the same time, synthetic ETFs change over time. So it's exactly like a fund. You're invested in equities. For instance, our S&P 500 is predominantly S&P 500 stocks we invest physically in. The only thing what you do is you have to swap overlay to get the tax benefit. Yeah, so it's not like a certificate. That's very, very important. Because with a certificate, you have 100% counterparty risk. It means if one of the banks who is giving you this exposure defaults, your money is gone. Okay, that's with a certificate. With
like, for example,
ETF,
for the ETCs or ETNs or ETPs, right?
That's for ETNs.
Yeah.
Exchange traded note. For an ETC, they are backed up by the asset. For instance, the gold ETC, structurally, you're right, it's a debt instrument, but the ETC is 100% backed by gold, physical gold. So an ETN, which is a note, is like a certificate. Yes, there it's not backed, so you have 100% counterparty risk. And that's a very important thing. Synthetic ETFs, they're safe, because they invest into securities. You have ownership rights of the securities. And so look into detail what you invest in, but for synthetic ones, there is not more risk than for the physical ones who do securities lending. That's very important. Yeah.
So maybe, given there are plenty of abbreviations, we can summarize this point again, because it's a very important point. So for ETNs, like the name says, it's exchange-traded notes. And with notes, you have the counterparty risk of the issuer. So if whatever name issues a note, then you have the counterparty risk of this issuer. With the ETCs, there is also an issuer, but they are usually physically backed, right? So
they're always physically backed. Correct.
And then third, we have the ETFs, where we distinguish between the physical replication and the synthetic replication.
Correct.
And there, with the synthetic replication, you are basically saying that you are ring fenced as well, or that your exposure is in this sense secure.
It is secured, with a synthetic, and within the physical ones, you have two methods. One is the full replication, where you invest 100% in the stocks of the index. And the other one is optimized. So you invest partially into those stocks of the index to get the exposure, but then your tracking error is a bit higher.
Maybe we can go a step further into building a portfolio. And many people, they use ETFs for building a portfolio, especially when it comes to the core part, but not just the core part, also the satellites, how we usually split the portfolio into a very solid and longer term oriented core part, and then the maybe more the fancy investments as the satellites. So what kind of ETFs would you choose for your core portfolio?
I mean, it really depends what your aim is, how old you are, what your target is, what you want to achieve, what you want to buy in a couple of years. So that's now my portfolio, so to say. Doesn't mean everyone has to do it that way, because it really depends on what you want to achieve. And so having said that, as a core for me, who wants to invest over the next 10, 15 years, would be a global equity exposure, ideally including also emerging markets. So these indices are either FTSE All World, that's a per default index, which is used very often by investors to get this core exposure, or MSCI World All Country. That means the all country means emerging markets are included as well. So these are two of the indices or ETFs that I would say good for exposure in a core. And then shall we speak about the satellites as well? Or?
Yes, of course. But maybe before we move to the satellites, I mean, we very often get the question whether you should rather go for one global index to really get the global equity exposure, what you mentioned just right now, or whether it's better to pick the various geographies on a standalone basis. So let's say I buy an ETF in the Swiss market on the SPI, for example, another one on the S&P 500 to get the US exposure, and I can warehouse a bit more flexibly between the markets. What is your take on that?
To be honest, you have to rebalance a lot. You know the problem, because the good thing is if you buy one ETF, that's the global equity exposure. Now, if you buy, I don't know, a bunch of different ETFs of different markets and regions, the better the one market performs, the higher your exposure will be towards that market, which means in the end of the day, if you keep this portfolio static the way it is without any rebalancing, you have massive deviations and concentrations on certain markets, whereas some other markets will have lower exposures in your portfolio. and at the same time, then you increase your risks, so to say, because of the concentrations that you will have. Of course, you can do the rebalancings, let's say on a quarterly basis yourself, but then you generate transaction costs, which you also don't want to do, because trading, I don't know, 10 ETFs can be more expensive than just buying one and keeping that one, or buying on a regular basis that one exposure. So personally, I wouldn't do that. Yeah, and the other thing is, I didn't do the math now, but I think if you buy all the single countries selectively, it will be more expensive than just buying one on the management fee. Because specifically emerging markets usually is more expensive in the ETFs. If 10% or 12% of the global exposure is emerging markets, and then you pay somewhere around 30 to 60 basis points management fee, that could make it more expensive as well. Yeah.
So you're all for simplicity.
I'm yes. Just buy one ETF that's simple. Don't make it too complicated. Because the more complexity you bring in, the tougher it will be to follow it, to manage it.
That's what we're saying as well very often, is that it's better to have a simple portfolio.
Yes.
And the most important is to have a portfolio, to be invested in the equities market.
For sure,
And it's not better if you have an extremely complex portfolio. On the contrary, it needs a lot of dedication.
Correct.
And a simple portfolio can be absolutely by far the best solution.
Yes. I mean, that's you have the core, and then build around the core. You can build the themes that you want.
So what are your favorite themes at the moment?
That's usually I see it as mega trends, for instance. Yeah. So what do you see as trends for the next 10 years? Because if that's something that you want to, if that's the time horizon you want to invest, I mean, that's again my personal view. It's the blockchain technology. I believe that this technology is really a game changer for our entire industry, but not only for the financial industry, but for all the industries. Yeah, because it eases transactions, it eases contracting, smart contracting. It eases, basically our life as well. Yeah. So this, for me, is a mega trend. So then I invest on a lower scale than the core portfolio, clearly, because it's more risky. But on a lower scale into blockchain ETFs, that gets you the exposure to those companies that are responsible for the ecosystem blockchain. Yeah, so that's one area where I believe in. And then, all over tech. If you believe in tech companies, that's also something that broadly tech, I think, makes sense to be invested in.
I agree, and we have been discussing this on a recent team launch as well. Even though tech has moved by a lot over the past few months, it's still the area where, I mean, the music is playing, basically, and where the biggest developments might be happening. Yeah,
no, that's true. That's true. I mean, you could invest into Nasdaq, but something actually, what is coming up more and more is China tech. I mean, they seem to be quite ahead. No, I mean, in 10 years, I think China or Chinese tech companies.
Well, we got a preview with DeepSeek, no?
Yes, exactly. Yeah. I mean, that was already, you could see with less chip capacity, they were able to produce DeepSeek. And I mean, that could be a bet where you can have a tiny position over the next years and build it up. And let's say in a decade time, China tech could be the area to be invested in. And what else is important? One area I invested in, it didn't perform, but still it's a mega trend. I would say it's around renewable energy, clean energy. It had very tough times over the last 2-3 years, I know.
And it's not getting easier, no?
It's not getting easier as well with the US administration, but still that's something we need to evolve. And that's something that over long term, 10, 15 years, it has to change, right? So, and there it's actually good to be invested via ETF. Yeah, because you're broadly invested, diversified. Yes, you lost 50, 60% over the last 12 to 18 months because the space had tough times.
And it's also a big area, right? I mean, you can invest in basically alternative energies more towards the commodities, but then also towards technology. Everything is involved somehow.
Yes, exactly. Yeah. I mean, you can buy a broadly global clean energy ETF, for instance, where you have all the exposures. So that's also one area where you could get your megatrends in.
And the other trend you mentioned at the beginning is the actively managed ETFs. So what does it mean? Actively
managed ETFs. It isn't managed actively, as the name says, but there are a few parameters.
Surprise.
No surprise. But there are a few parameters. What can be an active managed ETF? So first, it's called enhanced strategies. It's quantitatively managed products with very, very low tracking error. Tracking error means the difference between the benchmark and the performance of the ETF. So very low risks that the quant team takes to be a bit above the benchmark, ideally. So that's one area, so quant-driven active management. The second one is in areas, for instance, in the fixed income space, you can add value with active management because you have illiquidities. It's a lot done through primary market. So the fixed income space, there you could add value. So I think fixed income ETFs, active fixed income ETFs, definitely have a space to grow. Then one other area is what the financial asset management industry is working on is income strategies. They're quite interesting. So you can generate income with option strategies, which are managed actively again, and yield, for instance, 10% on a certain US equity exposure. So that's something that is coming into the market as well. So there are more and more providers who
basically,
launch.
When I listen to you, it's all the actively managed ETFs are somehow rule-based.
Yes.
Yeah.
Because the problem is if you take high conviction strategies, which means very concentrated managers, it's tough to manage them in an ETF wrapper with intraday liquidity, with intraday trading. Because sometimes these positions they have is like 15, 20 positions, small cap names. An ETF is built to be a billion product, multiple billions. So it's not possible with high conviction strategies. And at the same time, you have to be transparent daily, showing the positions. Many managers, they don't want that.
And it's traded on a continuous basis, what would be difficult with a conviction strategy.
You can have some problems if other managers see daily your positions, and so that's not going to happen. In the US, it's different because in products, the ETFs are not transparent. So you have transparent ETFs. So or with time delay, you can show the positions. Okay, if there's a regulatory change, I read a couple of months ago the Irish regulators looking in Europe to change that as well, to have this in transparency for the active ETF space. Okay, then it can be different. If you have a 30-day delay in showing your positions,
why not?
Then why not? Yes, but it is at the current time, it's not the traditional active that we know, but more like systematic strategies which are in ETF wrapper. Yeah,
very
or
interesting.
the European space.
Yeah. Do you see other trends on the horizon?
Yes, there is one trend which is in the fixed income space. They're called target maturity ETFs. At the moment, interest rates in the US dollar terms, euro terms are quite interesting. So what you can do is you lock in the high yields for the next 2 to 3 years. It's like a deposit, basically. For 3 years, you invest into US dollar investment grade, for instance. The day you invest in, you know what your yield will be. And then quarterly, you have your distributions. And
So
in the end, your payout.
You buy a portfolio of bonds.
You buy a portfolio of bonds, 300 to 400, broadly diversified. You know your yield will be around 4.5%, 5%. So depending on the horizon, etc. On the day you invest in as well. And then in the end of so let's say you invest over 3 years, December 2028, you will get your complete investment back. And meanwhile, you will get your coupons quarterly. And then the ETF is liquidated.
Okay. This is a really interesting concept. If you basically buy a portfolio instead of one single bond.
Correct.
So very curious what other trends might be coming up over the next months. But I believe for now we learned a lot from you, Nima. Thanks a lot for all your insights. And as with our guests, we usually ask 3 questions at the end. And you can just answer very spontaneously without a lot of thinking. Okay. So it's all finance related. So it's easy for you. So stocks or bonds?
Stocks.
Then tech or financials?
Tech.
And gold or Bitcoin?
Bitcoin.
Oh, you are really a modern investor. Glad to hear. So to all our listeners, if you have any questions, please write us as always at hello@youmushroom.com. And if you want to have a look at the very interesting solutions of Invesco, you can go to youmushroom.com, log in or sign up and go to the investments menu, filter for ETFs and funds and for Invesco as an asset manager. I hope you will find all these interesting solutions. If you are interested in the saving plan of Neon, you can go on your Mushroom to the Neon broker page, and there you find all the necessary information in respect to these saving plans. So I hope these insights will help you to win this investment challenge. And in case you haven't signed up so far, you can also go to youmushroom.com. We wish you a lot of luck, and we are very curious to see who is leading. Thank you very much and see you soon. Money!
What Your Bank Doesn't Tell You, a podcast by YouMushroom.